Welcome to Positioning a Business for Sale. I'm Toby Tatum, and over the next 30 minutes or so, I'm going to explain all the things that a business owner really needs to know and the things a business owner must do in advance of offering a business for sale in order to successfully sell the business. First, we're going to talk about what positioning a business for sale means. Then we're going to look at why is positioning a business for sale necessary, and finally, what does positioning a business for sale entail? The first thing we're going to talk about is what positioning a business for sale means. Most small business owners are only going to sell one business in their lifetime. But the idea of positioning a business for sale is not that much different than positioning a house for sale or a car for sale. What's the first thing a homeowner does once they place an ad for sale of their home or list their home with a real estate broker? They're going to do some touch-up painting. They're going to clean up the landscape. They're going to take care of minor repairs and do all those things that are going to make the home as presentable as possible so that it's attractive to buyers and makes their home stand out from the rest and get as high a offering price as they possibly get. And the same thing with selling a car. The day that an ad comes out for the sale of a car, what's that car owner do typically? They're going to wash the car, vacuum it out, probably wax it, make it look as nice as possible. And so this is what positioning means. It means doing those things that are necessary to make the business stand out from the rest, to make it attractive to buyers, to make it as saleable as possible, and to position it so that the seller can get as the maximum price possible for the business. There are two main reasons why it is so important for a seller to effectively position his or her business for sale. The first reason is competition, and the second reason is high business sale failure rates. First, let's consider competition. According to a study conducted by the Pepperdine University School of Business Administration, at any given time, approximately 3% of business owners intend to transfer ownership and/or control of their business as soon as possible. 18.3% intend to do so within the next 12 months. We see that approximately 6.1% of business owners intend to transfer ownership and/or control within the next 1 to 2 years. 32% within the next 2 to 5 years. 31% within the next 5 to 10 years. 3.6% within the next 10 to 20 years, and approximately 6.1% of business owners do not intend to transfer ownership and control for over the next 20 years. Pepperdine University study found that 60.4% of business owners intend to transfer ownership by selling their business. 13.2% intend to transfer ownership and control via an inter-family transfer. 13.2% intend to bring in a financial partner, that is to sell a part of their business. 6.1% plan to sell to their employees via an employee stock option plan, an ESOP. And the balance of 7.1% are undecided as to exactly how they will transfer ownership and control. The important thing to note here is that 21% of business owners intend to transfer ownership within the next 12 months. And 60% of that group intends to do so by selling their businesses on the open market. From this, we can conclude that 21% of 60%, or 12.6% of all small and lower middle market businesses, are for sale at any given time. In other words, slightly over 1 out of every 10 businesses is for sale at any given time. This means that there is enormous competition among business owners to sell their businesses. The second reason it's so important for a business owner to properly position his or her business for sale is due to the high business sale failure rates. It's interesting to note that in the preceding graphs, none of the respondents indicated that they intended to go out of business, close up shop, sell their equipment, remaining inventory, and just walk away. Although entirely anecdotal, there is general agreement among professional business brokers that approximately 80% of small businesses offered for sale do not sell. Think about it, 80%. To be more specific, the general consensus is that among businesses with annual sales below $2.5 million, only about 1 out of 5 that's offered for sale will sell. Among businesses with annual sales between $2.5 million and $10 million, there's a general agreement that approximately 1 out of 3 will sell. Among businesses with annual sales between $10 and $50 million that are for sale, approximately half will sell. In nearly all businesses with annual sales above $50 million a year will sell. The general consensus of business sale failure rates among business brokers notwithstanding, different brokers have different results. Some claim they sell as many as 80% of their listings. However, this is not attributable so much to varying sales skills among brokers, but largely attributable to their listing policies. These listing policies can be viewed on a continuum, from those brokers who will list any business at any price the seller desires, to those who will only list businesses that are reasonably well positioned to sell or can be made so, and where the owner-seller is willing to establish a reasonable asking price. Among the brokers that are willing to list any business at any price, approximately 2 out of every 10 businesses listed for sale will sell, and at the opposite end of the continuum, among the highly discerning brokers, approximately 8 out of 10 businesses they list for sale generally will sell. At this point, let's take a look at the main reasons why most small businesses won't sell. Let's look at the 14 reasons that help ensure that a small business will not sell. Long-term history of operating losses, long-term downtrending sales revenue, long-term downtrending earnings and cash flow, highly volatile sales revenue, key operating costs and earnings, skimmed cash, poor quality or confusing bookkeeping and financial statements, little time left on the premises lease, problematic lease assignment clause, problematic franchise agreement assignment clause. The business and real property owned within one legal entity. The existence of non-operating assets that the seller expects the buyer to buy. A spiderweb organizational structure. The owner's unrealistic expectations of what his or her business is worth, and the owner's unrealistic expectations of the terms of sale. In other words, the seller wants all cash at closing. The balance of this presentation, we will address these 14 obstacles to selling a business in detail. There are 2 overall guiding axioms a serious business seller must know at the onset of the business selling process. Every business owner who aspires to sell his or her business must first and foremost heed rule number 1, and that is to look at what you're offering for sale from the buyer's perspective. To quote John Stuart Mill from his essay On Liberty, 1869, "He who knows only his own side of the case knows little of that." The idea being that business sellers and their brokers should consider the asking price from the buyer's perspective. Ultimately, this is the only way one is likely to establish a reasonable price at which the business is likely to sell. Business sellers should be aware that the vast majority of serious buyers look at many businesses for sale before making an offer. Sellers who consider themselves clever by pricing their business on claims of tremendous potential with certain phenomenal earnings growth beginning tomorrow need be aware that this ploy is as old as the hills and seldom impresses buyers. According to Shannon Pratt, universally recognized as one of the world's foremost authorities on the valuation of privately owned businesses, the seller would like to be paid today for what the business could be worth in 5 years if a buyer brings in additional capital, manages well, and is very lucky. Some owners seriously entertain that pipe dream. The buyer, of course, does not see it that way. He wants to pay only for ongoing earnings that the business has already proved it can produce with a high degree of certainty. With respect to the 2 positions above, the real world leans much more toward the buyer's perspective than the seller's. So do divorce courts. Value is based largely on what is there now as opposed to what might be there sometime. Would-be sellers are misled when they think they should be paid now for what the business may be worth after the buyer brings his own magic show to the party. Without regard to a seller's asking price or hoped-for selling price, the serious seller should obtain professional advice on what constitutes a fair price. This is because the second overall guiding axiom the serious seller must know at the onset of this business selling process, an axiom with which nearly all business brokers will agree, and that is, The first offer is almost always the best offer. If a seller is tempted to turn down the first purchase offer received, that seller had better make that decision with the knowledge of his or her business's professionally estimated fair market value. The landscape is littered with sellers who have turned down the first offer only to eventually sell their business for far less, and in a very large number of cases, fail to ever receive another offer. By far, the single most important consideration business buyers make, and the first thing they want to know about a potential acquisition, is the business's historical financial performance for the past 3 to 5 years. This is because there's almost universal agreement among buyers that a business's historical financial performance is the best indicator of its probable future performance. Buyers want to see 3 to 5 years of consistent profitability, preferably trending up. However, approximately flat is acceptable. Buyers will generally pass on companies with downtrending profitability and will almost certainly pass on companies with downtrending sales revenue and downtrending profitability. Buyers are also wary of companies where annual sales, key operating costs, and profitability are highly volatile. That is, show extreme up and down spikes from year to year. In other words, bounce all over the place. This is because it becomes far more difficult for buyers to make reliable estimates of what the company's future performance will be like. Admittedly, to some degree, a company's trend in sales revenue and earnings are attributable to forces beyond the control of the business owner. They are driven by the ebb and flow of national, regional economic forces, new competition, industry trends, and so forth. These uncontrollable forces notwithstanding, to a very significant degree, the reported historical financial performance of small and medium-sized businesses reflect the conscious decision of their owners to intentionally underreport earnings and or the owner's failure to institute and maintain high-quality bookkeeping and accounting practices. Small and medium-sized business owners' propensity to intentionally distort the true profitability of their companies is widespread, almost a universal practice to some degree. It is a well-recognized fact that owning one's own business can perhaps be the best tax shelter there is. It is a common practice for business owners to extract income from their companies in the form of a variety of prerequisites or owner perks, such as purchasing and charging all the costs of operation of a luxury automobile as a cost of doing business. Much travel, entertainment expense, and meals, not really a necessary cost of doing business, is frequently reported as such. Indeed, the creative ways that business owners find to conceal personal or family economic business benefits as necessary costs of doing business is almost limitless. In retail businesses and other cash and carry businesses, it is a fairly common practice among some business owners, and completely illegal, by the way, to simply skim cash. That is, to put the customer's cash payments for merchandise directly into their pockets and never record the sale on the books. What business owners fail to realize when engaging in these practices is the hidden cost associated with them when it comes time to sell their business. Think about it. If you conceal and thereby underreport your business's earnings by $1 and your combined state and federal income taxes say 30% of earnings, then you've really only improved your net income by 30 cents. That is the tax you would have paid. The other 70 cents would still have been yours. But almost all businesses sell for a multiple of their historical cash flow, generally ranging between 1 and 4 times 3 to 5 years average historical cash flow. So assuming for this discussion that the market value of your business is 3 times historical cash flow, then under reporting $1 cash flow, you have made 30 cents, but you have devalued your company by $3. That's a 10-to-1 trade-off. Is it worth it? The risk of being audited by the feds aside. Well, if you're not planning on selling your business, perhaps. However, if you are contemplating selling your business within the next 5 years or so, it would appear that underreporting your company's earnings may not be the smartest thing to do. It's true that business buyers will make some reasonable allowances for this type of behavior among business sellers and pay a price based on adjusted financial statements. However, there are limits to how far buyers will travel down this path, and those limits are fairly stringent. Buyers draw the line at skim cash, however. Almost never will a buyer pay a higher price for a business based on the seller's representation of additional sales revenue that was never reported on the books and not reported on the federal tax return. Based on years of experience examining the financial statements of small and medium-sized businesses, it is clear to me that establishing and maintaining excellent bookkeeping and accounting practices is not a high priority for many of their owners. Generally, that seems to be okay with them because they are able to maintain acceptable financial control of their companies nevertheless. Unfortunately, poor quality financial reporting is not okay with business buyers. Simply put, excellently prepared financial statements for the last 3 to 5 years make a business much more marketable. Or stated in opposite terms, poorly prepared, often undecipherable financial statements can render an even very profitable business unsaleable. To some degree, what constitutes excellent bookkeeping and accounting practices is a matter of opinion. However, if in doubt, which in my experience many business owners should be, it will be money well spent to get some professional advice on how best to properly format your profit and loss statement in particular so that it comports at least approximately with your industry and generally accepted accounting practice standards. If you are reporting on a cash basis, this can be problematic when presenting your financial statements to prospective buyers. Financial statements prepared on an accrual accounting basis are far easier for buyers to evaluate. As I just stated, in my capacity as a business appraiser and business broker, I have examined the financial statements for hundreds of small businesses. So far, I've yet to encounter a small business where the quality of its financial performance reporting could not be improved. Interestingly, though, nearly all small business owners believe that the quality of their financial reporting is very good. Thus, there is quite a gap between the opinions of most small business owners and myself regarding what constitutes excellent financial performance reporting. As a way to bridge this gap, I wrote the book, Turning Black Ink into Gold. The subtitle of this book is How to Improve Your Company's Profitability and Market Value Through Excellent Financial Performance Reporting, Analysis, and Control. I have published this book as an ebook, and there is a link on my website that will take you to the site where it can be downloaded. Based on my experience reviewing the financial statements of small businesses, I can absolutely guarantee any small business owner that the advice I provide in this book, if implemented, will ultimately result in that business owner's ability to improve his or her company's profitability and market value. This is a very short book, perhaps better described as a booklet that is only 76 pages long, comprised of 20 chapters, each only a few pages long. The chapter titles are Introduction, Cash versus Accrual Accounting, The Danger in Minimizing Your Tax Liability, Improving Planning and Control via Improved P&L Formatting, How to Analyze Your P&L, Controlling Your Cost of Goods Sold, Controlling Labor Costs, How and Why to Develop a Break-Even Analysis, Improving Financial Control through Comparisons to Industry Averages, Introduction to the Balance Sheet, Introduction to an Analysis of the Balance Sheet, Detailed Analysis of the Balance Sheet, Fixed Asset Management, Considerations Concerning Debt Financing, Strategic Management of Inventory, Accounts Receivable and Accounts Payable, Return on Investment Analysis, the Altman Z-Score, Cash Flow Analysis, Bookkeeping Policy and Procedures, and Conclusion. After examining the historical financial performance of a contemplated acquisition, the next most important attribute of a business buyers generally look at are the terms of the lease for the real property within and upon which the business operates. Buyers are reluctant to buy a business where location is important or moving expenses high if there are less than 5 years remaining on the current lease term and no pre-priced extension option. Extension options would stipulate rent to be determined are really just an illusion of an option, not a real option. Generally, a short time remaining on a lease for a location-sensitive business renders it at best less marketable and less valuable, and more often than not, unmarketable. For buyers truly interested in acquiring a particular business with a lease that will expire in the near future, the task falls to the buyer to negotiate a new lease with the property owner as a condition for closing on the acquisition of the business. In this case, from the buyer's perspective, whatever new higher rent he must pay can be offset simply by making a concomitant downward adjustment in the price paid for the business. For these reasons, the best strategy for the business owner contemplating selling his business is to renegotiate a lease with a remaining term of less than 5 years or so before putting the business up for sale. Another extremely important aspect of a lease is the assignment clause. Most commercial leases contain such a clause. The point of departure in crafting this clause in a commercial lease is that the current tenant cannot assign or sublet the property without the property owner's permission. However, in accordance with the Uniform Commercial Code, such permission shall not be unreasonably withheld. Unfortunately, most commercial leases will include one or more caveats to this basic assignment condition, and these caveats will always favor the property owner to the detriment of the tenant and often make the marketability of the tenant's business considerably more problematic. The kinds of caveats that may appear in a commercial lease are limited only by the imagination of the property owner. Common caveats are such things as the business having a stipulated net worth or having substantial experience operating the kind of business the tenant is operating. The buyer will need to be able to obtain insurance in the types and coverage amounts stipulated in the lease. It is not an uncommon requirement that the business owner tenant pay the property owner an assignment fee. I have heard of assignment clauses that grant the property owner a percentage of the profit the tenant makes on the sale of his business. Also within this clause, the current tenant business owner will often be beholden to a continuing guarantee, meaning that if the property owner assigns the lease to the buyer and if the buyer subsequently defaults on the payments, then the former tenant shall continue to pay the monthly rent until the end of the lease term or when the property is released, whichever occurs first. Avoiding the need to a continuing guarantee in a commercial lease is often impossible. However, there is room for negotiation in how long this guarantee endures after the lease is signed to the business buyer. Obviously, it is in the current business owner tenant's best interest to make the time span of the continuing guarantee as short as possible. Moreover, should the business buyer default on the lease and trigger the requirement that the former tenant resume paying the rent, this legal requirement does not automatically imbue the former tenant with the right of re-entry to resume operating his former business. For all of these reasons, it is a wise business owner who has the eventual sale of his business foremost in his mind at the time he negotiates the lease terms with the property owner when first going into business. In a similar fashion to the assignment clause in a commercial lease, business owners operating franchise businesses will be party to a franchise agreement or franchise license that will also contain conditions of assignment or transfer. Sometimes these conditions can be extremely onerous, so much so that they can severely negatively impact the marketability and or going concern value of the franchise business. In this case, however, renegotiation of the franchise agreement is almost certainly going to be impossible. Whatever conditions the current franchisee agreed to are what he will have to live with when trying to sell his business, and this in particular includes the universal inclusion of a franchise transfer fee, along with the need to negotiate who will pay it, the buyer or the seller. In this instance, the only time a business owner can have any control over the influence that the franchise license will have on the marketability of his business will be during original negotiations. Many business owners also own the real property within which their business operates. For nearly all small businesses and most medium-sized businesses, the owner should hold possession of them in separate legal entities. The owner should then charge the business fair market value rent. The principal reason for this being to accurately assess the true profitability or return on investment, if you will, of the real property and the business independently. Additionally, such an arrangement gives the owner the added flexibility of extracting some of the business's earnings in the form of rent, rather than wages and bonuses. Income from rent does not carry the burden of Social Security, Medicare, or state unemployment insurance payments. Most importantly, however, is that when the real property and the business are held in separate entities, the business becomes substantially easier to sell. Many business buyers do not want to also purchase the real property, and in a lot of cases, the most likely business buyer will not have the financial wherewithal to purchase both the business and the real estate. By holding the two elements of the business separately, the owner has the flexibility of selling the business and leasing the property to the buyer, or selling the business to a strictly business buyer and selling the real property to a strictly commercial property investor, or selling the real property and the business to the business buyer. Moreover, the time of the sale of the two entities need not have to coincide. Additionally, should the business buyer want to also buy the real estate, it is much easier to obtain financing and often in greater amounts for the real property if it is purchased separately. And finally, by holding the two parts of the whole in separate entities, it becomes far easier to develop an accurate assessment of the fair market value of each. Bottom line, holding the real property and business in separate entities and charging the business fair market value rent makes each more marketable and quite possibly somewhat more valuable. Fixed assets do not create going concern value in a business. This aspect of valuing a business is probably counterintuitive to most business owners. The fact is that the more money a business must invest in operating equipment in order to produce a given amount of sales revenue and earnings, the less will be that business's market value as a going concern. For example, consider two identical businesses with identical sales revenue and identical operating costs. However, assume one of the business generates its sales revenue with operating equipment worth $500,000. Next, assume the other business generates its identical sales revenue with operating equipment worth $1 million. Assume the useful life of this equipment is 10 years. This means that on average that the first business will have to reinvest an additional $50,000 per year for fixed asset replacements. The second business will have to reinvest an additional $100,000 per year for fixed asset replacements. Assume the buyer's required rate of return on cash flow to invested capital is 33%. This means that the business with the greater investment in fixed operating equipment will be worth $151,515 less than its counterpart. In other words, 50,000 divided by 0.33. There's a very important aspect to this concept that will affect many businesses. It is not at all uncommon for unused operating equipment to accumulate in a business, be it an older model machine that has been replaced with a new model, or perhaps a perfectly good machine that is not being used and there is not much likelihood it will be used in the foreseeable future. If the cost of this accumulated non-operating equipment is still on the balance sheet, it will have the effect of reducing the company's market value. This is so because the buyer will include the cost of this equipment when calculating the average annual fixed asset reinvestment cost, which then reduces the free cash flow to invested capital. This means that the right thing for an owner to do who is contemplating selling these businesses is to get that equipment off the balance sheet. In other words, sell it before placing the business on the market. Whatever money that business, that used equipment fetches will be gravy on top of the selling price for the business. It should be clear now that a company's assemblage of fixed operating equipment and its value do not create or improve a company's market value as a going concern. The only thing that creates value is the after-tax cash flow to the business owner that equipment generates. What this means for a business owner contemplating selling his business is that there may be a possibility that closing the business down and selling the equipment and inventory will generate greater proceeds than the proceeds that would be generated by selling the business as a going concern at a price the cash flow supports. In fact, this scenario is not at all uncommon. However, in a formal fair market value appraisal, the going concern value estimate includes the assumption of an all-cash at closing selling price. If seller financing is introduced into the equation, in many cases, it may still be possible to sell a business as a going concern whose liquidation value is greater than its fair market value as a going concern. Another important positioning consideration is the legal form of your business. Most importantly is whether your company exists as a C corporation or as one of several types of pass-through entities, such as a subchapter S corporation, limited liability company, partnership, or sole proprietorship. The reason being that the federal income taxes you must pay on the profit on sale for a C corporation are significantly greater than the profit on sale tax for any of the pass-through entities. If your company is a C corporation, you should seek legal and accounting advice to determine the current advantages of this status versus the potentially greater income taxes you will pay when you sell it. However, from a buyer's perspective, the legal form of your business is generally not an important consideration. If your company is a C corporation with just a few stockholders, you can convert it to a pass-through entity at any time. Unfortunately, taking this action does not immediately place you in the pass-through entity's lower tax bracket. The federal income taxes you must pay on the profit you make on the sale of your business will still be calculated on as though still a C corporation basis. The Internal Revenue Code does not allow the owner of a former C corporation that is converted to a pass-through entity to enjoy the full benefits of a pass-through entity's lower tax on sale status for the first 10 years after the conversion. Nearly all small business owners strive to increase their company's sales revenue and earnings and generally have many ideas on how to do that. Indeed, perhaps the most common term used to describe a business offered for sale is its growth potential. This is because buyers are especially attracted to a business that demonstrates a strong potential for growth. This being the case, it is a wise business owner who positions his business to exploit that potential. As a business grows in sales revenue and earnings, it becomes a more complex entity. It employs more people. It offers a broader array of products and or services. It starts operating from multiple locations, and so forth. In every such growth scenario, a business reaches a point where the spider web organizational structure typical for very small businesses won't work. That is, the business where the owner-manager calls all the shots, where all company policies and procedures exist only in the owner's head and are communicated verbally, where all new hires are trained personally by the owner, where the owner carries out all purchasing and marketing activities. The business owner who initially succeeds in increasing sales revenue and earnings but fails to create an organizational structure capable of supporting that growth with its inevitable increase in complexity will eventually see his business either fall back to its previous size or, what is more typically the case, fail. Call it the paradox of success. Thus, for any business owner offering his business for sale who touts significant growth potential in terms of potential growth in sales revenue as a key value driver, should be able to back up that capability by demonstrating an organizational system capable of assimilating that growth in order to make the claim believable to a buyer. This task is far easier said than done and does not happen overnight. It can take several years to accomplish. However, once this task becomes well accomplished, the business will become more marketable and more valuable. The final thought on positioning I want to address here is a proper positioning of your expectations for the future sale of your company. That is, your expectations of how much you can sell your company for and on what terms. Perhaps the single biggest reason profitable businesses don't sell is attributable to the unrealistic expectations of their owners. Rarely do small and medium-sized business owners have a reasonably accurate idea of the most probable selling price range for their companies. Generally, however, they harbor hopes, and those hopes generally again range anywhere from double to 10 times the price their business is likely to fetch. And that's the price they ask when they put their businesses on the market. The result, of course, is that no purchase is ever tendered. How business owners come to believe that someone will pay their dream world asking price is one of life's greatest mysteries. Rarely does a business owner seek an unbiased, professionally developed opinion of value when contemplating selling his business. Some business owners simply rely on a herd-on-the-street rule of thumb. The problem with this pricing methodology is that there's no such thing as a universally applicable business value rule of thumb. And this includes what is probably the most common one of them all, which holds that a business is worth 3 times earnings. There are hundreds of business value rules of thumb, and they are all industry specific. Thus, applying a business value rule of thumb applicable to a business in the X industry to a business in the Y industry will yield a completely inaccurate indication of the most probable selling price range. Sometimes business owners will apply an earnings-based rule of thumb appropriate for businesses in their industry to a definition of earnings different from the definition a particular rule of thumb or other valuation method requires. This too will result in an incorrect estimate. There are several different definitions of a business's earnings. Different valuation methods are based on different definitions of earnings. If one employs a particular valuation method and uses the wrong definition of earnings, you're going to end up with a completely incorrect value estimate. It's important for anyone, a business owner or a business appraiser or a business broker, to know which definition of earnings that a particular valuation method requires. Should it be net income? Should it be seller's discretionary earnings? Should it be earnings before interest, taxes, depreciation, and amortization with the acronym EBITDA? Or should it be earnings before interest and taxes with the acronym EBIT? Or should it be net cash flow to invested capital or net cash flow to equity? These are important considerations, and a misunderstanding of the definition of earnings that a particular valuation method employs will absolutely guarantee that you're going to come up with an incorrect opinion of value. Another common misapprehension is the notion that regardless of a business's past 3 to 5 years earnings history, the real value of a business is embodied in the current owner's opinion of his business's future earnings potential, coupled, of course, with fantastically optimistic expectations. It is absolutely true that buyers are only buying a business's expected future earnings. That's all that is possible to buy. However, buyers base their estimates of a business's expected future sales, earnings, and value almost entirely on a business's preceding 3 to 5 years historical cash flow. As the saying goes in the business brokerage industry, buyers buy the future, but they pay for history. To further compound the inability to sell one's business due to an unrealistic asking price is seeking unrealistic terms of sale. Most business sellers initially want an all-cash at closing transaction. Unfortunately for sellers with this desire, the majority of businesses that sell transact on terms requiring the seller to partially finance the purchase price with a seller carryback promissory note. Business sellers who insist on an all-cash at closing deal thereby reduce the pool of qualified buyers by about 90% and render their business either unmarketable or marketable only at bottom dollar. The result is that a significant percentage of businesses for sale, which include all cash at closing terms, don't sell. There are 2 primary reasons for this. First, a buyer who has enough cash to buy your business for all cash at closing has enough cash to buy a business 2 to 5 times more profitable than yours if the seller will carry paper. And most sellers will do this, albeit reluctantly. Secondly, in the eyes of most buyers, a seller seeking all cash at closing has a business with a big warning sign hanging over it saying, "Buyer beware, I'm dumping a loser." Buyers view a seller's willingness to carry paper as the single greatest form of assurance that the business is everything the seller has represented it to be. Beyond all of the preceding are potentially many other positioning details a business owner should consider depending on the circumstances and nature of his business. A business seller should expect potential buyers to require him to provide a written and signed seller's disclosure statement, wherein the seller reveals all the facts and circumstances about his business known to him, the good, the bad, and the ugly. The seller who lies or withholds material negative facts about his business in the representations made in this disclosure statement or the purchase agreement should absolutely expect to be sued by the buyer post-transaction. Moreover, the standard by which the court will assess a buyer's damages will not be based on what the seller claims he believed to be true or was unaware of about his business prior to closing, but on what he should have known. Thus, the best way to bring a business to market is to first eliminate the bad and the ugly, whatever that may be. This concludes my presentation of positioning your business for sale. Hopefully you now have a better appreciation for the challenges involved in selling a small business and a better understanding of what you can do starting today to be able to sell your business. Good luck and best wishes.